Good evening, everyone. And once again, thank you for joining us. My name is Nei Irebi Aqua, and I'll be your host for today's session. Before we start the program, I'd like to introduce the organization, Africa Center for Tax Policy Research, briefly. Okay, so this is a little bit about us, the Africa Center for Tax Policy Research. We are a non-profit organization established in 2018 by young tax professionals in Ghana. It is focused on non-partisan tax policy research, and it was established to promote a better understanding of tax policy that impacts businesses and the national economy through careful, steady, thoughtful evaluation and open debate. The main purpose is to promote and facilitate nonpartisan research, analysis, and discussion of tax policies. Membership is open to any professional who is interested. We are just interested in good debates with a view to improving tax policy in Ghana in general. We can be reached at africa.taxpolicy@gmail.com. So for those who are interested in joining us, you can send us an email with a brief biography about yourself, and then we look forward to you coming on board and being part of the conversation and what we are trying to achieve. So thank you very much. Now, the session we're having today, as you've seen in the title, is a virtual tax clinic. And the idea is to address the frequently asked questions of the lay person, the non-technocrats, the citizen. Government is currently encouraging us to pay more taxes, to be compliant and all that. For most people, it's a lot of jargon that they struggle to make sense out of. So this is an initiative we've come up with to try and educate the average person on tax policy in general, especially as relates to personally, to improve compliance and get more people interested in tax. So thank you very much. The last session we had, which I hope some of you were able to join, was on filing of tax returns. So this session is a follow-on from last week's. That session is available. We can share the link for those who are not able to join. Today's is a continuation or building on that. We are going to learn about managing our P.A.Y.E, especially on how to minimize our income tax in a legal way, what we call, so that I don't have any legal problems. Thank you. So I'm going to introduce our speaker, and then he's going to take us through the session. Our speaker today is, once again, Francis Timor. He's a tax expert. He's been practicing taxation for the last 15 years, and he has lots of insights and experience to share with us. So Francis, please, if you are ready, you can start your presentation.
Thank you, Albert. And I believe
thank you, everyone.
Yeah, I believe you can hear me. And thanks for joining us. We want to keep this presentation short. Like Albert introduced, these are frequently asked questions that we get from people whose job is not tax, or who normally would ordinarily not be working on tax matters, but for some reasons, they are caught up in the payment of taxes. We got this question from somebody who said, look, I want to use legitimate means to reduce the amount of P.A.Y.E I pay. So what are the ways I can do? So strangely enough, the question kept coming, and we thought that, look, let's create this platform so that we can discuss the matter looking into the law. So tonight, in the next 30 or 40 minutes, I'll try and take you through the basis of taxation. I like the basis of taxation because it gives us a perspective of why government want to levy tax on us. We'll be discussing the classification of tax for the classification of income for tax purposes. Because this discussion is about employees, we'll look at what constitutes an employment income. And then we'll dwell a little bit on the P.A.Y.E system that is being used to collect taxes from employees. Now we go into the tax planning, but I must say that this area is a limited tax planning opportunity for employees. So we will look at the handful tax planning tools available for people to minimize legally the tax liability. And then we will look at the relief system. The relief system, what system is available for us to reduce. We'll try and look at the forms that you need to complete. And then because the intention is to keep it short, we thought that, look, we can have another session that discusses other forms of managing our P.A.Y.E, and that is why we titled this one Part 1. So in our next session, we'll look at how do we employ benefits in kind to reduce our tax liabilities. And so that's what we are going to discuss in the next few minutes. So the first point is, look, what is the basis of government asking us to pay tax? And the last session, we explained that tax is paid out of wealth, and the more wealthier you are, the larger you are expected to pay. Now, the system is such that the law is built on when you create wealth. If immediately you create wealth, for example, by working, your employer pays you salary, we say you have created wealth, and creation of wealth will result in income tax being imposed on you. So a salary worker will have a P.A.Y.E imposed on him because he has created wealth. So assume that he has had some money. Now, when you create a wealth and you want to hold it, maybe you after creating, you want to build or acquire houses and you hold it. Immediately you decide to hold it, we expect that property tax will be levied on you because you are wealthy and your wealth is in properties. Now decide to sell it or decide to transfer it. It is expected that because you are selling it, you are parting way with your wealth. And so capital gain tax will also kick in. What about somebody who says that I'm not going to work, but I have money transferred to me every time from UK or somewhere, and mine is to just consume. So whilst you are consuming, then we expect that consumption tax will be imposed on you. Sorry. So this has been the basis for government taxing us. Tonight we are referring to people who create wealth through employment. So let's look at the classification of income according to the sources that our tax law has laid down. So in Ghana and mostly around the world, if you create a wealth and you have income, we can classify the income into at least 3 main sources or pipelines. So we have income from employment. Within Ghana, you can make reference to Section 4 of the Income Tax Act. If you make money from business, we say you have income from business, and Section 5 says that you should pay tax on your business income. What about somebody who does not do any of the two above, and then he also does investment? Section 6 says that we should pay, or we should slap on you tax from investment. And so any income that you get can be classified into these 3 elements. I have highlighted the first one because that's going to be the major discussion point that we're going to have. So you can have capital gain tax, you can have gift tax. In the current tax system, we have subsumed it under any of these 3 heads that are available. Because we are talking about employment income, and at the end of the day, we are going to see how we can manage and legally reduce the liability. We need to know what is an employment and therefore what is employment income. Section 4, like I mentioned, says that the income of an individual from an employment for a year of assessment is the gains and profits. So any gain or profit that you derive from the employment, whether it is in cash or in kind, the law says that it is income, and therefore we should bring it within the ambit of the assessment. We need to assess tax on you. So how do we then determine employment? We have to have employee. There must be an employee, and in the law, section 133 defines employee as an individual who is engaged in employment. There must be an employer. The employer in this case is the person who engages another person, and therefore he remunerates him in an employment. And we are saying that in all this, there must be an employment relationship. There must be a contract, underlying contract between the two people. This distinction is important because in some cases, somebody will be doing his business. He is self-employed, and the principles remains different if you are in business. Now, what should we include in the employment income now that we have been able to define who an employee is? The law almost includes everything that we get from the employment relationship. Everything that you get from employment, unless it is specifically exempted under the law, almost everything must be included. So, for example, salary, wages, leave pay, fees, commissions, and gratuities must be included, overtime and bonuses, personal allowances, including cost of living, discharge or reimbursement of expense. For example, if you are a boss and your employer pays for your electricity at home, the employer is discharging that expenses on your behalf. So it is, the assumption is that you've gotten some benefit from the employment, and therefore you should pay tax on that employment. Even retirement contribution, if it is not approved for tax exemption, so your employer has set up some personal pension fund somewhere, the law says that the benefits and therefore has to be included in your employment income. Other benefits, including gifts. So a hotel waitress is somewhere, and every day he gets some tips. They are gifts that he has received relating to the employment, and therefore it has to be included in it. And then I like the last IX. It says that any other allowances or benefit paid in cash or given in kind, if they are derived by the individual during the year from employment. So like I said, almost everything that one can think of, as long as it is related to the employment, the first assumption is that it must be included in the assessment. However, the same section 4 says that we should exclude certain things when we are assessing the person's employment income. For example, if the income is exempt, there are some list of items which the law says that we should take it out. We should not include it in the assessment. So under that circumstance, it is completely exempted from tax. So that is, and then you also have, if you have a final withholding payment, things like dividends and all those things, if you receive them, the law says that we should exclude it from the assessment. We are not going to include it in it. And there are some expenses like discharge of dental and medical expenses. We want to keep you healthy. So your employer will give you some health insurance or some health medical allowances or other things, which is paid for your health. In other words, it is not a blanket cash which is given to you. There are some instances where you are given cash, whether you are sick or not, you are given that cash. But in this case, we are talking about health insurance. It is a benefit that you've gotten from the employment, but the law says because we want to keep you healthy, and therefore you should remain healthy and work, with such amounts are not going to be included in your assessment. You can think of other expenses. The list is long. For example, even provision of accommodation. It is assumed that provision of accommodation is an income, because if we did not give you the accommodation, if we don't give you the 2-bedroom furnished or even raw accommodation, you would have used your same salary to rent. So if we give you accommodation, the law is such that we should include it as a benefit in kind. However, if it is provided for you and your employer is in the business of mining, building, construction, farming, or timber or petroleum, then we are saying that should be excluded. We are not going to add it. The general assumption is that, look, if you are provided with a accommodation on the farming site, to what value is this accommodation? It's likely to be like in Tabodine or something. So generally, we do not include such benefits in kind in your assessment. Redundancy pay is also not supposed to be included. But here, you've got to be careful because redundancy has been defined under the labor law. It's not every redundancy which qualifies. Some redundancy may not necessarily be redundancy pay. So we need to bring it within the meaning of the Labor Act, whether it constitutes redundancy pay. And then VII makes some provisions which says that if a payment is made to employees on a non-discriminatory basis, and by which reason of the size, type, and frequency of the payment are unreasonable or administratively impracticable for the employer to account for or to allocate to an individual, that should also be excluded. Take, for example, in the office, there's a coffee machine. Somebody will go and take coffee, and then another person will also decide not to take. So within the day, it will be difficult to allocate and say, Kofi Mensah took 2 cups of coffee. Or take, for example, canteen. Kofi Mensah may go there and then go and eat 2 bowls of kenkey, but somebody will go and eat half bowl. How do you allocate it? So the law has made provision and said that sometimes when the payment is non-discriminatory and then it is difficult for you to allocate, then that should also be taken out. You don't have to account for it. So technically, almost everything, unless it is specifically stated, like I mentioned, exempt amounts should be taken out. We are not supposed to tax it. The list is also long. For example, you can look at pensions. If you receive pension, if you are retiring and a pension amount is paid to you, we're not going to tax you. The salaries, allowances, facilities, pensions, and gratuity of the President of the Republic is also not taxable. So the first man in Ghana doesn't pay tax on his employment income as employee, as an employee of the Republic of Ghana. Capital sum paid to somebody for compensation as personal injury suffered by that person or for the death of another person. So maybe some insurance company has given you some capital sum for some injuries. The law says that we should take it out and it's not supposed to be taxed. The list is quite long, and then we can look at section 7. But in all this case, the employee is subjected to what we call the P.A.Y.E system, pay as you earn. And it's a system which is applied to employees. And the system works in such a way that before the employer gives you the money, it is deducted at source and then paid to the GRA 15 days following the month. People say that this system, when it was introduced, is very convenient because it is the employee pays the tax at the time when he's having the money. I bet you, if they ask us to go to GRA to go and pay this amount by ourselves, when they give us the full amount, I'm sure many people will not go. So section 114 places the obligation on the employer that the employer is supposed to do the deduction. Section 114 says an employer shall withhold tax from the payment of an employee. An employer shall withhold tax from the payment of an amount to be included in ascertaining the income of an employee from the employment. Then 3 says that the obligation of an employer to withhold tax under subsection 1 is not reduced or extinguished because the employer has a right. So in other words, it is not negotiable, this obligation. If you have a right that you ask for your income, it's not supposed to be deducted. It is neither here or there. B says that any other law provides that the income of an employment from the employment shall not be reduced or subjected to attachment. You can go into any contract arrangement and say that you are going to use your full salary to pay for something that you have entered into. The law says that we must apply the withholding tax and take the P.A.Y.E from your income from employment. So how is it determined? The rule is that we have to assess your total employment income. When we assess you, then we can deduct the allowable deductions. And this is the only way employees can have some planning measures. So your assessable income, that is all your income from employment, we assess you, then we minus or we deduct the permitted deductions under the law. Then we get your chargeable income or your taxable income. So your taxable income, we apply the rates, the applicable rate, then we get your tax liability. Okay, so how then do we plan? The only way we can do that is to increase our deduction. In other words, the income has been given to us by the employer. The only way it will be reduced so that you can get a lower taxable income is to increase your deduction. So tax planning in this case is just increasing your deduction. the question is, how do we increase the deduction? Generally, employees do not have enough deductions available to them. If you're a businessman, you can deduct all sorts of expenses. But for employees, our deductions are very limited. And worst of all, Section 8 says that subject to the sixth schedule, the Commissioner General shall not allow a deduction for the purpose of ascertaining the income of a person from employment. So the general rule is that the Commissioner General will not allow you to deduct expenses unless it is specifically mentioned in the law. So as a businessman, you can deduct your rent, you can deduct your transportation expenses and all form of expenses. But when it comes to employment income, the law is saying that the Commissioner General does not allow us to deduct expenses that we incur in generating the employment income. So you can take Uber to work, you can hire a car. That expenses that you have incurred in order to get the employment income, the law is that you are not permitted to deduct it from the employment income before we tax you. So what then are the deductions room available for us? They are only in the form of personal reliefs and some only one deduction. So let's look at the reliefs that are available. So the Income Tax Act provides 4 major allowable deductions for us to reduce our tax liability. And so the planning mechanisms center around this area. That is the planning mechanism. So there are 4 of them. Personal reliefs, contribution to approved retirement funds, mortgage interest deduction, and donation to a worthwhile cause. So tonight we're going to discuss these areas, 4 of them. That is the only way you can use to reduce your tax liability. Let's look at the personal reliefs. And we said that personal reliefs, they are approved deductions that are granted to an employee or an individual. And the purpose is to reduce your assessable income. And the more we reduce your assessable income, like we said, then the lower your tax liability becomes. So it is to reduce your assessable income. The more you have them, the more your the income that is available to tax becomes smaller. And normally, we take into consideration the personal circumstances of the person. Take, for example, a married person who has children and the children are going to school. It is likely that that married person will be hard pressed than somebody who is not married and who does not have any other responsibility. So the personal circumstances are always taken into consideration when we are granting this personal reliefs. So what are the conditions? We are saying that the reliefs are mostly individual. And so if you're a business or you're a company, you can't claim them. It is for individuals. And then it is available to only resident individuals. So if you are non-resident, you cannot claim it. And then they are also year specific. So you cannot go and claim the years which are past. You can't get them. It is lost. So you take it or you lose it. And they are personal in nature. So I cannot transfer my personal relief to, let's say, Abraham, because maybe I am not married, and then under the law, the law says that marriage relief is available. So I'm not married, so I'm transferring it. Or maybe I don't have 3 kids, so I'm transferring it to another person. No, it doesn't work like that. So let's look at the available reliefs under the law and how we can take advantage of them to reduce the liability. So the first one is marriage or responsibility reliefs. Currently, it is 1,200. And it is given to any person who has a dependent spouse, or even if you don't have a spouse, but you have at least 2 children who depend on you, then it is given to you as a relief. So the relief is currently 1,200, like I said, and it is only one spouse, only one of the spouse, either the husband or the wife, is entitled. And the reason is that we want to give it to you to reduce the burden on you, because you have somebody depending on you. And we know in our traditional settings, husband or a wife, if you have dependents, they will put some pressure on you. So that is the reason why we give you 1,200. It used to be in the 1986, it used to be 25 pesos, but now we have it as 1,200. Now the person must depend on you Either your spouse is dependent on you, or your two children are, if you are not married, your two children are dependent on you. And dependent is defined as any person you provide the necessities of life, the necessaries of life. So food, shelter, accommodation, and everything, you provide it. So you can claim 1,200 from the GRA, or you can claim it to reduce your taxable income. Let's look at the second relief, which is child education relief. Now it is 600 per child, and you have up to a maximum of 3 children. So technically you can claim up to 1,800. The purpose is that it is to assist you take care of your children in school. And it is granted to a person who have children or ward. It doesn't necessarily have to be your biological children. Maybe they are your wards. And they must be recognized educational institutions in Ghana. Again, only one of the parents can claim. So if there are 3 children, the father can claim 3. Or if there are 4 children, the father can claim 3, and then the mother can claim the excess 1. You can't both of them claim this in respect of the same children. Let's look at the next relief, which is disability relief. This is a special one because as far back as the 1992 Constitution, the Committee of Experts, they paid special attention to it. In the Committee of Experts paragraph, in their report, the report that gave birth to the 1992 Constitution, paragraph 175 says the committee paid particular attention to the status of disabled persons and proposes the following provisions to protect them. In other words, they noticed that disabled people in the community require some attention, and they gave so many recommendations. And then the 9 says, special incentives such as tax reliefs should be given to disabled persons engaged in business, and also to business organizations that employ disabled persons in significant numbers. You and I know that not traditionally, disabled people are less privileged in the society. Consider a blind person. A workforce is, a company is unlikely to employ a blind person to work. So in the 1992 Constitution, Article 29 made it more or less like a fundamental human right, and said that special incentives, Article 29(7) says, special incentives shall be given to disabled persons engaged in business, and also to business organizations that employ disabled persons in significant number. Parliament shall enact such laws as may be necessary to ensure enforcement of the provisions of this article. So, since Constitution time, we have decided to make some provisions for disabled people. And in the Income Tax Act, we are saying that they are entitled to 25% of the assessable income as a relief. So it is limited to only business or employment. Of course, a disabled person can do investment. So investment does not require physical effort, which disability comes in. So 25%, and if the person qualifies to be disabled, the condition is that for you to be classified as a disabled person, the Department of Social Welfare must satisfy you. They will examine you and give you a certificate that you are disabled, and therefore you qualify for this relief. The next relief that I want to talk about is old age relief. Some people are old, 60 years and above, but they are still working. They are still working. The law is that we should give them a relief because after 60 years, you are on retirement, but you are still working. And so the relief is 1,500 cedis per annum. And then we compare with the total income. So if the person's income is, let's say, 1,000 cedis, then the whole income is even granted as a relief. And it is available to people who are 60 years and above. Normally, you will not find this one in employment unless maybe the security services where retired people are engaged. Now, the next one is age dependent. And age dependent, we are talking about people who have relatives who are 60 years and above, and such relatives depend on them. So your mother and your father, they are aged and you still take care of them, their medical and their food and everything. The law is that you can claim up to 2 of them, technically your mother and your father, which means that you can get like 2,000 cedis. Recently, what the GRA requires is that you must produce their Ghana card to indicate that they are 60 years and above. And again, if you are 2 relatives, only one of you, maybe your brother or you and your brother, one of you can only claim in respect of this relief. And the person must be 60 years and above. The law also makes provision for training and improving ourselves. And it says that if you undertake any training or professional or technical or vocation training to upgrade your knowledge, then we will give you a relief up to the amount you spent in training yourself, or 2,000 Ghana cedis, whichever is less. So if your training is more than 2,000, then we will limit it to 2,000 Ghana cedis. So you can take this relief and then. So that has been the personal reliefs. Let's look at how you claim it. So this relief that we've spoken about has been categorized into two forms. We have upfront, one that you can immediately claim, and this one you can even use your employer to claim it. Okay, you can use your employer to claim it. I'm told that the font size are small, so I was trying to see if I can enlarge it. Albert, let me know if you can see the screen or it's still smaller.
Well, I think the person is that the text that you've typed. So probably maybe later on we might edit it and increase it a bit.
Okay.
But the slides will be shared. So maybe he can note the particular slide he can see so that when he gets the slides, he can read it more closely.
That's fine. And maybe if you are viewing it from your phone too, I think that it will look smaller. Forgive us, but we'll share the slides with you so that you can have a look at it. So kindly note it and then you can ask your question. So the reliefs come into two forms. You can have one which is upfront, and normally it is given on a monthly basis. With this one, you just have to complete a form. Your employer will endorse it and say that he's satisfied that the information you have provided, for example, your children, your old father, and then your disability, everything is correct. You send it to the GRA, the GRA will endorse it, and then you can claim it on a monthly basis through your payroll. There are others that you are also supposed to file your tax returns. So when you file your tax returns, then you can claim it. So those that are upfront are marriage or responsibility relief, child education relief, old age relief, age dependence reliefs, and then disability relief. These things you can claim them upfront. How do you apply it? Regulations 10 says that you have to apply. It is not automatic. It's not available to everybody because the GRA will not be able to determine whether you have a disability. So you need to put in an application and your employer is supposed to satisfy it. Normally, it's recommended that employers should do this on behalf of their employees because it is a way of reducing the tax liability of their employees. Now, this is the form. It's available on the website of the Ghana Revenue Authority. One caution is that if you go there, some of the reliefs may not be available to you. So for us, we have amended it to ensure that those portions of the reliefs which are stated in the law, which is not on the form, we have inserted them. So you fill this form, your name, your social security number, the name of your employer, your wife's or your children's name, their date of birth, and everything. You sign, your employer will also sign. You submit this form to the nearest GRA office. They will process it and then they will grant you your relief. So, ladies and gentlemen, that has been the first major tool that you can use to reduce your tax liability, the personal reliefs. Let's speak to the contributions to approved retirement fund. We all know that since 2010, the pensions law was revised in Ghana, and it created a 3-tiered pension scheme. We know tier 1, which is the mandatory, which is Senate, and then tier 2, which is the occupational mandatory as well. And then the 3rd tier is a voluntary one. Most companies don't do this. But the rule is that even if your employer is not doing it, all you have to do is that look for an approved pensions or approved provident fund within your locality. Register with them, and it is a form of savings. So you can contribute up to 16.5% of your basic salary. This one, it can be done either together with your employer. So let's say your employer is doing 10%, you are doing 6.5%, or even you alone, if your employer is not doing it, you can do this one. And then any amount that you contribute will go to reduce your tax liability, to be treated as part, or to be treated in the same way we treat SNET, and then we reduce your tax liability. If it goes beyond 16.5, then you will not get the tax relief or the tax deduction for it. And again, it is not every pension fund. It has to be approved by the National Pensions Regulatory Authority, NPRA. You go to the NPRA website, there are plenty of them. So you can use it as an investment to save money. The caveat is that when you start, because government intends to make it like an investment tool, you have to remain there, you have to invest for up to 10 years. If you decide to withdraw, you get a tax of 15%. Some say, look, instead of me paying tax at 30%, I can put it there and pay and withdraw it later and pay 15%. They still, I'm able to save like 15% tax I'm able to save like 15% in taxes. But the whole idea is that you must keep it there for a minimum of 10 years. And after 10 years, when you withdraw, you don't pay any tax on it. The next tool that I want to talk to you about is mortgage interest. And I must say that this is the largest planning tool you can ever have. Assuming you intend to acquire a mortgage and you want to do that through a mortgage company, or you take a loan either to construct your own house or to acquire a mortgage house, as long as it is for the construction or acquisition of a primary residence, the law is saying that any interest that you incur on the loan, we should grant it to you as a deduction. So you'll be able to deduct it from the payment of your tax. So your total tax, if it is 10,000, and assuming that you have paid mortgage interest of, let's say, 5,000, we are going to deduct the 5,000 to reduce your income that we are going to subject it to tax. And then the next one, the last, which I want to talk to you about, is donation for a worthwhile cause. The law requires that we have some wealthy people around us, and they are individuals. They may be tasked to go and do some donations for charity. And if you do that, the incentive is that we should give you a relief or a deduction for it. So Section 100 says that if an individual, if a person donates or contributes to a worthwhile cause, then that person may claim a deduction from his income. And the law continues to list things that are considered as worthwhile cause. So charitable organization which has been approved by the GRA, so maybe Osu Children's Home or any of the charitable organization, as long as you are able to prove that you have done a donation, or you have donated to a scholarship scheme, that one you can also get a deduction for it. Or you donate to the development of any rural area or urban area, you can also get a deduction for it. Or you are a fan of sports, and therefore you contribute to sports development or sports promotion, maybe Black Stars, you want to go and assist, you do that, and then you can get a deduction for it. Or any other worthwhile cause that has been approved by the Commissioner General. So ladies and gentlemen, this, like we mentioned, that the tools are very limited because the law is such that for individual employees, we don't have enough deduction. The next batch of deduction, which we would like to talk about in our next session, will be how do we manage the benefits in kind to reduce our tax burden. So for example, if you are given a company car, should you be given a cash allowance, or the company can give you a coupon? Or should you be given accommodation, or should you be given rent allowance? Or should you be given a staff loan, and how much should be given to you? So because we decided to keep this short, we will end here, and then this will be considered in our next session so that we can make time for questions and answers. Thank you very much. And we are here for your comments, contributions, and then your questions. So Albert, if you can hear me, over to you.
Okay, thank you very much, Francis, for this very insightful presentation you did. So far, I've seen only one question in the chat box. I don't know if there are other questions that people want to ask. So maybe, Francis, you can start with the one in the chat box on the redundancy pay.
Okay, so then, the question is...
I have a couple of my own, but you start with that one.
Okay, so Joe Donko say, hi, please, what type of redundancy pay isn't exempt? Okay, Joe, so if you look at the word redundancy, it is a payment that we make to an employee, and it is an attempt to sever the employee from employment. The whole assumption is that within some time, this guy is not going to get a job. So any payment we made to him should not be taxed. However, the package may include, for example, outstanding leave. And normally, if you are retired, if you are being made redundant and you have outstanding leave, the traditional approach is that the company will calculate the outstanding leave and then pay it to you in cash. So, Joe, under that circumstance, we will say it is not supposed to be part of the redundancy, and so it will be taxed. Sometimes some packages are also given to you, which is more or less like if you were even in the employment, you would have received. So under that circumstance, it will be given. But normally, a redundancy pay will normally, it will even specify the number of years you have worked, multiplied by some basic salary over some number of months. That is how it is normally done. Anytime you load the redundancy pay with some other benefits which are not technically redundant, then it will not be given. And we must understand redundancy in this respect. It is the employer who is severing you. It is not you resigning. So if you are resigning from employment and you are getting some package, that is employment income, it should be taxed. Redundancy means that your job role that you are doing, we are not interested in it anymore, and then we are severing. So normally the GRA will analyze the package into detail. Let's look at the components. We don't just accept one line as redundancy. Sometimes we even go ahead to check the formula you use in calculating the redundancy pay. I believe that it's clear, Joe. You can unmute and then maybe speak if you want. Okay, Albert, if we can take the other questions.
Okay, there's another one. For clarification purposes, does an individual enjoy the total interest on mortgage as credit, or it is treated as a relief? Kindly clarify. This from patient Waji.
So normally, if it is given at the end of the year, you have already paid, and assuming that 2021, I was supposed to have claimed the interest on a monthly basis, and I didn't. Now I'm going to file my tax returns. Then the GRA will assess my whole 2021 income and then tell me that, okay, Francis, you should have claimed this amount, but you didn't. So we have assessed you and we noticed that you have overpaid tax. In that case, it becomes a credit for me. Now, if it's given to me upfront, then I can deduct it as a relief, as an interest deduction before applying the tax. So those are the two ways you can claim your mortgage interest. I believe that it clarifies. Dennis also says that, please, my hand is up. Okay, Dennis, kindly unmute and then ask your question.
All right, thank you very
Dennis,
much.
Okay, Dennis, please go ahead and ask your question.
Okay, thank you very much. It was a nice presentation. I enjoyed it very well, very insightful. But my question has to do with the mortgage, the relief with regards to the interest on mortgage payment. I have two questions. My first question has to do with, do I qualify if I should go for, say, a personal loan, but the intent of the loan is for construction of a house, a personal house for my dwelling? Although it may not be a mortgage, but I've stated in the loan form that indeed is for the construction of a house. In that case, will I qualify, since it's not a mortgage, but then the whole intent is the same as going for a mortgage? Because maybe I'm going in, maybe I'll choose that over a mortgage because maybe I got a good rate from my bankers on that level. That's why I went for it ahead of the mortgage. That's my first question. Do I qualify for the mortgage relief on that front? That's my first question. My second question, this is for auditing purpose. Let's say I'm an auditor and I'm going to audit a company and I see an employee enjoying a mortgage relief. You know, the practice notes gives out the list of the things that needs to be done before the employee qualifies, which includes evidence of writing to the commissioner for this, proof that the person is dwelling in the house, and proof of the loan agreement and everything. The person has everything, the proof of the loan agreement, the loan schedule, but we can confirm that indeed deductions are being made from the account for that purpose. But the person has not applied for it officially with GRA. He's not written a letter to GRA, or he's not for the tax relief form you showed us to GRA for GRA to sign and approve that indeed they've received it. But the person is deducting it from his salary. Does that person qualify even though he's not written to GRA, but then he has everything to show to prove that indeed there's a mortgage and he's making interest payment from it. Please, these are my two questions, please. Thank you very much.
Okay, so maybe let's address that question and then we can come to the other one. So, Dennis, if you read the Income Tax Act, particularly paragraph 3, it says that mortgage interest means interest incurred by an individual in respect of a borrowing employed in constructing or acquiring the individual's only place of residence. So mortgage in this respect does not necessarily mean the mortgage as we know. You know, when you go and take a mortgage, we say this is a mortgage company. So you are taking it from a mortgage company. As long as it is a mortgage interest and it is incurred in respect of any borrowing which you use in constructing your only place of residence, then I think that you qualify for a deduction for it. It doesn't necessarily have to come from Ghana Home Loan or any other place. The only thing is that you need to be able to prove that this money, you use it in the construction. And I think that the simplest way you can prove is that the loan application, even the term sheets, should specify that, oh, this person took this loan. The contract between you and the bank or whoever, wherever you took the money. This person took this loan and the purpose was for him to complete his house or for him to acquire a house. And that house is his only place of residence. That you can make a strong argument in respect of this before the GRA, and you should be able to get this entitlement. The second bit is a little tricky, and it is because of this high court ruling between what is the name? GRA versus what is that, FIFA or whatever. Now that case came up because somebody said that he's entitled to that treaty. He's entitled to that relief. And
hello, sorry, please.
Hello.
Yes.
Yeah, can you please repeat what you said? I missed it.
No, so I was referring to the second question by Dennis. So Dennis' question was that he has all the documents specifying that he has taken a mortgage, but he has not written to the GRA to tell them that he needs an approval. And I was saying that in some other jurisdictions, you need, in fact, the tax authorities work with the GRA, because if you leave it blanket that way, you are likely to have problems, because the GRA will come and tell you that, look, I am not aware, or I'm not going to grant you the relief until I am satisfied that this loan was used to acquire the person's house, and also it is your sole residence, and so I can grant you this one. To avoid this problem, we are saying that make the application to the GRA in advance, send all documents to them, and let them prove and let them review. And when it is approved during an audit, you are unlikely to find these problems. And this procedure is indeed what is being done in other jurisdictions like UK. UK also has a mortgage interest deduction, but theirs, they don't allow the individual to sit in his office and then claim it. Based on the GRA, the High Court decision of GRA versus, I've forgotten the other name, but I can even share that case with you. Now, based on that, people are saying that, look, I don't need the GRA's approval to be able to take a deduction for my mortgage. But my view is that if you take that position and the GRA also wants to prove difficult, they will ask you that you need to prove that, and you need to prove to their satisfaction that indeed this loan was acquired to construct your own house, and that house is your only place of residence. So Dennis, that would be my approach. First of all, submit your documents, everything to the GRA before get a prior approval. When you get a prior approval, then you can claim it. Better still, if you have not done so, file your returns, submit all your documents that indicate that you have taken the loan, let them review it. And then when they review it, at the end of the day, you can claim it in the form of a tax credit. The danger for employers to accept is that if I bring anything to you and I tell you that this is a mortgage and I use it to acquire my only place of residence. In fact, the condition is that it must be your only place of residence. You shouldn't acquire 3 or 4 houses. If it is not my only place of residence, what happens? The employer might have refused to deduct the appropriate P.A.Y.E, and then problem comes. That is why it is advisable that seek approval from the GRA ahead of time. I believe that clarifies your question, Dennis.
Yes, please. Thank you very much. Sorry, one last thing. You looked at the arts. I think at that point I lost connection. I didn't hear it. With regards to the first question.
Look at the sixth schedule, paragraph 4, subparagraph 3. It will tell you what a mortgage interest is. So sixth schedule, paragraph 4, you can read the whole of that paragraph, and you notice that it makes provision for that. It will define what a mortgage interest means.
Okay, please, thank you very much. Very good.
Okay, Albert, do you have further questions?
Yes, there's one in the chat box, but just another question on the mortgage interest. Now, hypothetically, what happens if your mortgage interest is more than your income tax deduction? Does it happen that then the government will owe you money, or there's a cap on it?
So there's no cap. You can get that situation. So when you get that situation, what it means is that you will be in a tax credit position, and when you get into a tax credit position, government will be owing you. The rules regarding tax credit is that we'll use the credit to apply. We'll apply it against any future liability until you don't have any further liability anymore for some time. Then the GRA will give you a refund. I think the case someone has referred, Kwesi Nyantechi Oredu. Yeah, GRA versus Kwesi Nyantechi Oredu. Yes, thanks for that.
All
so
right.
You can get a credit, and when the credit is happening, we will use it to say offset future liability, or we'll write a check for you.
Okay. John Ashi also had a question. And I read, regarding leave pay, when an employee is resigning, can the leave money be treated as bonus / allowance rather than normal employment income, so that the graduated income tax rate will be avoided?
No, you see, bonus are specific, and bonus are paid either guaranteed bonus, or normally we call it guaranteed bonus, like 13 months is guaranteed whether you work or not. And then some are also based on performance. In this case, you are resigning and it's a leave pay. We know the number of days outstanding, unless you want to hide it, which is not advisable. The calculations are clear. It cannot be classified as a bonus, and it can also be treated as a guaranteed pay as well. So it is a leave pay converted to cash, which we are paying to you, and therefore it becomes taxable.
Okay, John, I hope that answers your question. Okay, well, he's not saying anything, so we take it that his question is answered. Please, are there any other questions?
So I see Ibrahim's hand is up.
Okay, thank you very much, Francis. And you've given us in-depth understanding of what's expected of us in terms of P.A.Y.E. So my question is concerning the upfront relief. I had this engagement with someone, and the person mentioned that if the employee does not make the application in the course of the year, for it to be granted to him, when the person is filing the returns at the end of the year, the person cannot claim the upfront relief, which I am not in agreement to that position. So I wanted to clarify. If I'm unable to make the application ahead of time for it to be granted, when I'm filing my returns, can't I claim all my reliefs, whether upfront or not upfront, at the time that I'm filing my returns?
So you cannot claim it that way, because Regulation 10 of the income tax regulation says that you must apply it. You have to apply it ahead. So if there's no application, and that's what we call the tax relief application form. So you have not applied it, then you sit in your office and then you do your own assessment, and then you submit it to the GRA and ask them that give me the relief. No, it will be difficult. Some GRA officers may overlook it and grant it to you, but strictly speaking, the rules under Regulation 10 says that you have to apply, and that form must go. Your employer must satisfy it your employer will sign on, and then you also sign. The employer will stamp it. That is the basis for granting the relief. Otherwise, all of us will be sitting in our offices and claim that we are married and then we have 3 children. Meanwhile, they don't have any child at all. So that is the essence. You can't do it whilst you are filing your returns. Again, somebody can allow it to go because you may know him or something, but the strict application of the rule is that you have to apply. If you don't do that, you are bypassing regulations 10.
Okay, and is it that every year you must make the application? Because sometimes you make the application and it takes several months. GRA does not respond to the application. So can they make it in such a way that there are some information, like maybe the person is married, if there is no contrary communication from the employer that the person is not divorced or something, the previous application should hold? Can't they come up with some measures? I believe it's because of the workload. That's why the applications delays whenever employees make such applications to them. So can't they devise any means to make some of the reliefs more or less constant when it's approved, unless a contrary communication from the employer is given to GRA?
You are right. If you read Regulations 10:1, it says the Commissioner General may, on application by an employee in a prescribed form and in accordance with procedures determined by the Commissioner General, issue to the employee a tax relief card satisfying the personal relief to which the employee is entitled under Section 51 of the Act for 1 or more years of assessment. So Regulations 10 says that the commissioner can do it for more than 1 year. But Ibra, the practice has been that they normally like to confirm it for just 1 year. I've had instances where child education, they are saying that it should not apply to kindergarten because kindergarten, when they go to school, it is not any form of education. They are just going to sleep. So the GRA officer is saying that, no, I will not allow a child education relief because I don't think the child is a school-going age. That is controversial. So by practice, they can do 1 year or they can do more than that.
Okay, thank you.
You may read Regulations 10 for more of the tax relief and tax relief card.
Okay, thank you.
Okay, Francis. Hello.
Yeah, we can hear you.
Yeah, Kwame Agbotui has a question. Is teachers' intervention paid by government taxable? I don't know what he means by that.
Yeah, Kwame, maybe you need to clarify if you can unmute and speak to what we mean by teachers' intervention. But as far as it is against or profit from employment, then it becomes taxable. What I can remember, the closest is this teacher's laptop. It came up and we discussed it on some platform. We heard that the government was going to give teachers laptop. The laptop is for them. The teachers are supposed to pay 30%, government will pay 70%. Technically speaking, the 30%, the portion that the government is paying should be quantified as cash and then given and taxed in the hands of the teachers, because the laptop is not for the employer. The employer is the government. If it is for the employer, then I will assume that the laptop is for me to do my work. But in this case, after taking the laptop, I can take it. I can take it and go and sell, and it becomes my property. So government is giving me money indirectly to buy a property. So under that circumstance, it becomes taxable. So the general notion is that any allowance, anything that is available to an employee as a result of his employment, and it is not specifically stated as exempt, then that becomes taxable. So I don't know whether you want to elaborate on what intervention means.
Hello, Kwame. So I don't know if you want to clarify that, but in the meantime, we'll move to John Ashi. He's asking if with leave pay cash, whether first and second tier will be calculated on it too.
So normally, anything that is paid as basic salary, then clearly it's supposed to attract the tier 1 and tier 2, and in some cases tier 3. But trust me, in most cases, some of these things will be paid as cash allowance rather than as basic salary. But Senate sometimes also pays particular attention to some of these amounts. You know, sometimes the employer will tend to reduce his portion of the tier 1 by converting most of the things into cash allowances. So it's possible that the payment, if it's not a cash allowance, it can be treated as a basic salary, and therefore, if it is prorated, it should attract tier 1 and tier 2. Paulo, okay, John Ashe has his hand up. John, maybe unmute and then speak.
Yeah, so that is a point I wanted to hear, that whether the law allows the leave pay to be treated as a cash allowance, and in that case, maybe a 15% tax or whatever tax applicable will be applied on that, so that the SNIT and the tiers will be avoided. I don't know if that can be done and it will be in accordance with the law.
So the company is free to pay you basic salary and also free to pay you cash allowance. There are instances where the company will not pay you any salary, but they will give you cash allowance. Now, if the leave pay is calculated based on some number of days, assuming that I'm supposed to work for 30 days, then when I'm on leave, I still get my salary. If you were not resigning, would they have paid you that salary? If it is yes, then tier 1 and tier 2 must apply. But in practice, what we see mostly is that because the employer wants to evade the 13% employer contribution, he will normally consider that as a cash allowance, and they normally call it leave converted to cash. And that is the point I'm saying, that technically speaking, it's a basic salary which the employer is supposed to pay tier 1 and tier 2 on. But in practice, you see them converting it into other cash allowance. And if it is other cash allowance, we'll treat it as normal allowance, and we tax it using the graduated rate.
All right, thank you.
Okay, any other question? Albert?
No.
Yeah, hello.
Are there any other questions?
Hello.
But great interaction, great feedback. Looks like we're very engaged with the material, which encourages us a lot. So thank. But you can always send your questions to the Africa Research email after here in case it comes up. So maybe we'll show the email again on the page, and then you can send your questions to that email and we'll respond to them. Yes,
okay.
africa.taxpolicy@gmail.com.
Robert, next session will be on the benefits in kind, and that will be pretty short because we don't want to keep members on the page for long. So we'll look at other benefits which are paid in kind. We'll look at the fuel coupon. Nowadays that petrol price is going up, should the employer give us coupon or they should give us cash? All of these things will be discussed in our next session, and we'll share the link so that we can meet and then debate this matter. So if there are no questions from me, Albert, over to you.
All right. So once again, thank you very much, Francis, for this very insightful session. Before I forget, I would like to encourage those of us who participated in this one that please tell your friends about this virtual tax clinic. A lot of these things are not widely known, and it would be good to share it with friends, colleagues who will benefit from some of the insights. And actually, it's free consultation if you think about it. Because ordinarily, you have to pay for some of this info, but it's free. So let's get the word out And if there are no questions, have a good evening and thank you for your time. Francis, thank you very much. We owe you one. Thank you. Thank you, everyone.